You are listening to Keystone's Stock Talk Show, episode 292.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week, just ahead of our first webinars of 2025, April 3rd and April 8th. Details on those to come. I will begin with our star of the week, Argan Inc., symbol AGX on the New York Stock Exchange, primarily an engineering and construction firm involved in the power industry. Specifically, the company focuses on the engineering, procurement, and construction of natural gas-fired power plants and renewable energy facilities. A recommendation just 1 year ago to our U.S. small cap clients, the stock is our star of the week, having jumped from $49 to $130, up 160% in the past 52 weeks. In our Your Stock Our Take segment, Brett starts with a viewer question on recent IPO Coreweave, symbol CRWV on the NASDAQ, a company using proprietary software and cloud services to deliver complex AI infrastructure at scale. Using Coreweave as an example, Brett shows us the current weakness in the IPO market and lets you know if the stock is an opportunity or one to avoid based on its current fundamentals. Finally, Brendan will chat to us about holding periods and Canadian fashion giant Lululemon Athletica, symbol LULU on the NASDAQ. Does the stock offer value after a recent pullback on the heels of its Q4 numbers? Brennan will let you know. All right, let's get into the show. My co-host, Mr. Aaron Dunn, he is traveling through Italy again this week, back in a day or so. But fortunately, I have the killer bees, Brett and Brennan, here, rescuing the show once again. How are you guys doing?
Doing well.
Doing good.
Ready for some webinars this week? We have them coming up. Yep. April 3rd and April 8th. The 3rd, 7 p.m. Pacific. The 8th, 7 Eastern. Who should attend? Investors looking for unique, profitable Canadian and U.S. small cap and dividend stock and large cap recommendations and advice on building that simple 2025 stock portfolio. We're going to talk Trump, tariffs, and your portfolio. From crisis comes opportunity. We're going to look at the simple process for building that simple 2025 stock portfolio. We're going to review the Magnificent Seven, Alphabet, Amazon, Apple, Meta platforms, Microsoft, Nvidia, Tesla, which to avoid. Is there a new buy on the horizon? We'll let you know. And we're going to talk about orphan stocks, the opportunity there. I talked about orphan stocks this weekend with Victor Adair, actually, on Money Talks, not Michael Campbell this week. We had a good conversation with Victor Adair, but you can listen to that. We may link that into one of our coming emails as well. But we look forward to providing that with you. 5 to 7 profitable recommendations, individual stocks. The tickets are selling fast. They're over, I think, 85% sold now for the first event. So again, they sell out every year. I advise get a ticket today.
Yeah, and just like one thing on that, like I've been having a lot of fun putting together my segment, and like as a part of the orphan stock segment, we're going to look at how to effectively, purchase low liquidity stocks. So I've really been having fun. It's a lot of work, but once you kind of get into it and get with the flow, it's fun to put together. And, even I've had a call with a client where I say liquidity and they stop me and they're like, what do you mean? And, we take it for granted, these terms, just as, they're common, or not common knowledge, but they're just, we know them well.
We use them every day, right?
We use them every day. Exactly. Where, the average investor that is just, starting to build their own portfolio may not. So, I think that it's going to be fun to kind of go through low liquidity, how it can be, an advantage to a small investor, and really how to, use limit orders and enter, low liquidity stocks. So yeah, I'm looking forward to doing that segment.
Yeah, and we're going to talk about, in that vein, the orphan stock opportunity. What are orphan stocks? How many do we find in a year? How do we find them? And when we talk about orphan stocks, we're talking about individual companies that are disregarded by the market for a number of years and, kind of get ignored and have significant upside based on some kind of catalyst that they experience or that we see on the horizon or has already happened. In most cases, for our research, it's already happened and the market has ignored it because it is an orphan stock. And we're going to give real world examples of that, then make a couple of recommendations on a couple of orphan stocks that we have been buying over the past several months to the past year. And great companies. And when we're talking about these stocks, they're higher risk, but the upside minimal, we're looking at 75 to 100%. That is the potential. That is not what they're going to do, but the potential is there. To take on that risk, you've got to have significant upside. And that's what we see in these companies in unique situations. You got to look through literally 4,000 or 5,000 companies, and we may find 3 to 5 in a year. So it's a unique part. It's a little bit different from the long-term capital compounding stocks that we're looking for, but they're kind of market anomalies and opportunities. And we'll talk about those in depth, in detail in that those 2 upcoming webinars.
Yeah.
All right, let's get to our poll question. Or Brennan, did you want to do poll first and then your segment, or what?
I mean, first of all, I was just going to make kind of a funny comment that Brett and I are kind of looking like some KeyStone minions over here in our in our turtlenecks.
I feel underdressed now that you guys have those amazing turtlenecks. The turtleneck is back, I've heard too.
Yeah, the turtleneck is back.
You tell me, kids, is it back?
I think it's back.
Post that in the comments, kids. Whatever.
Oh, you're so hip.
I know.
But yeah, I think we'll do Brett's or the poll first. We'll get Brett to look at the poll, and then I'll kind of jump into my little segment or a little piece that I wanted to talk about. So
we'll know if they're back if Aaron comes in wearing a turtleneck from Europe. Then we'll know. He's just turtlenecked up. Yeah. Either that or he's hiding his hickeys, which happens all the time. All right, that's Aaron's not here. We can say whatever. All right, let's move on to we're gonna do our poll question, right, Brett?
Yeah. So this poll really comes out of like a bunch of headlines I've been seeing. Is the U.S. stock market no longer exceptional? Historically, if you go back, really since World War II, it's just outperformed every other on an index level, every other country in the world by, in most cases, a significant margin. So is it no longer exceptional? So far this year, the S&P 500, NASDAQ, Composite, Russell 2000 are some of the bottom performing indexes in 2025. I think there was a couple smaller countries that really were lower, but effectively they're the worst performing indexes in the world. So is the US no longer exceptional? And the question I really ask is, have you actually changed your allocation to the US equity? Because there's been other articles and reports out about how mutual funds and funds have been seeing outflows out of the US into Europe and Asia predominantly. So have you increased your allocation to US equity? 35% of reviewers have actually increased their allocation to US equity, 49% no change, and 16% have decreased.
Yeah, I voted. I'm a part of the no change, the 49% there. That's what I voted. I haven't made any change, generally. I mean, just in with tariff uncertainty and concerns, there's, maybe certain sectors or segments of the market where, I'd be more cautious, near term, just with the uncertainty. But who knows, that might all blow over in the next week, or it might take 4 years for it to all blow over. Who knows? But, generally when it comes to looking at the US, I haven't made any big changes to my own portfolio.
Fortunately, in most cases, our time horizon, particularly when we're looking for good long-term capital compounding stocks that we want to own, is longer than 5 years. Mm-hmm. So it outlasts any sitting government. So whether you think that's a risk, an issue, or anything, we're looking beyond that. It's my belief there will be some opportunities and, in some of the big tech. I mean, you see some of those, rightfully so in some cases, but some trading at valuations that you haven't seen on a price to cash flow basis in 10 years. So with still solid growth and growth avenues ahead of them and just fortress balance sheets. So if you can take advantage of that, if you're looking 3 to 5 years out, there's, if we go into complete protectionist environment, that's another story. That's likely not good for many U.S. centric companies are based in that region. But there's some tremendous companies there, tremendous balance sheets that do business all over the world. If this becomes a footnote 6, 8, 10 months out, then you probably entered a point where there's some good buying opportunities. That's the way we're looking at it right now. It can always change if the environment continues to be protectionist and it really follows through on that. So,
Yeah.
All right.
Yeah, I was just going to say that's like a beautiful segment or segue. You just referenced holding periods. Let me jump into
Perhaps I knew
a little piece.
what was coming up.
Perhaps you did know. Did you know?
Did
Okay.
you, though?
So, yeah, I just wanted to do a quick little segment at the beginning here because I spoke with a client last week about how investor holding periods are declining and thought that it was an interesting phenomenon. So I got him to go over or to send over some articles on the matter and also did some research on my own. And I found an article which was published on December of 2021 from the World Economic Forum, which is titled Long-Term Investing, What Are the Reasons Behind Its Decline? And up on the screen right now, I show an image from that article of the change in holding periods, where back in the 1950s and 1960s, holding periods were between 5 to 8 years for investors. But more recently in the 21st century has declined to below a holding period of 1 year. And they are measuring this by the value of stocks divided by turnover. So I thought I would quickly go through what this article is indicating is driving the change. So number one, they indicate technology advancement, and this includes automated trading systems, which have greatly increased the number of trades that can be processed each day. And this also includes high frequency trading and algorithms, which as of today represents 50% of trading volume in the US equity markets. So this is definitely a huge factor. As well, we could add technology advancement to social media and information overload, which has also led investors to become more active rather than buying and holding stocks long term. It has evidently made people more reactive to their investment decisions, and the ability to trade has become more accessible through trading platforms essentially, or online discount brokerages. Now, number two here, lowered cost of transactions. So, commissions, for example, as one may be more prone to executing a trade if they know they are charged low commissions or none at all. Now, the third is corporate longevity is also in decline. This article indicates in 1970, companies that were included in the S&P 500 had an average tenure of 35 years, but by 2018, average tenure was down to 20 years, and by 2030, it is expected to fall below 15 years. So altogether, these are generally the factors which are creating holding periods to decline. And just to conclude this little section here, before opening it up to the guys, this week we are going to create a poll on YouTube to see what our listeners believe their average holding periods are for their equity investments. So please look out for that poll and please vote in it for us so we can review the results next week. Any comments, guys? No worries if you have no comments.
Yeah, no, I mean,
I think it's
it
pretty
is
self-explanatory.
interesting. It's interesting to see. I mean, I would say that high frequency trading and lower commissions, like the ease of trading, if you look 20 years ago, the cost on just even for a retail investor to, you could get into thousands of dollars in commission to trade in and out of an individual security if you're buying significant amounts, of shares. Like they priced it on a per share basis at one point, right? Crazy. So the ease of, but there is also just generally ease of trading is made it simpler to go in and out of a company. But and the way it's promoted, how do some brokerages make their money, you moving in and out of securities over time, that has been part of it. But generally society wants things like right away right now too. You just see that across many things, and there is a lack of patience. It creates opportunities, though. We see that all the time, there's one company I was looking at today that may be selling off, just likely a long-term opportunity, and it's likely just near-term impatience that is causing it. So it is interesting.
Yeah. And like one thing that I'd also say is like, back in the day, where were you getting your quotes on stock prices? You're getting it from like the newspaper. You're like looking at the quotes in newspapers, and
You know
then
how we used to do it? On a phone.
well, and I was just gonna say, I
So
remember vividly,
sometimes,
like
like
always
retail
going
investors.
yeah, exactly, like going on ski trips, and my dad would be driving with his headset on, and he would be calling and basically getting them to repeat all the quotes that he wanted back to him. So it's like a little phone call where it's like automated sending them back to him. So like that's how he would check the quotes daily rather than just pulling it up on your phone. Like it's so easy to do now.
Yeah, or a terminal. Those were the ways
Yeah.
to pay, right?
Yeah, the one other thing which your infograph didn't really mention is change in products. So we had a shift from mutual funds to ETFs as well, and ETFs are just so much easier for people to jump into exposure, whatever country, industry, and so on, jump out in and out over and over again, versus mutual funds having that bit more rigidness to it. Or ETFs are just generally more flexible, and they also feed into high frequency traders if they can get the basket of stocks all together and then make a new ETF unit. That also feeds into that as well, I would say.
Yeah, definitely.
For sure. All right. Should we move on to our next segment, ladies and gentlemen? All right, let's do that. So this week, I am going to look at a company called Argan Inc., which should be no stranger to our U.S. small cap clients. The company has been in coverage for just over a year. The trades are around $129. It's about a $1.77 billion market cap, 1.15% yield. What does Argan do? Well, they are primarily a construction firm involved in the power industry, about 74% in the last period. Industrial construction services, 23.5%. Telecommunications, about 2.5% of the business. They conduct their operations through wholly owned subsidiaries. The company provides a full range of engineering, procurement, construction, commissioning, maintenance, project development, and technical consulting services to the power generation market. Their service offerings focus on the engineering, procurement, and construction of natural gas-fired power plants and renewable energy facilities. Now, the stock, it surged on March 25th of this past week, up 25% following the release of strong Q4 and fiscal year 2025 numbers. Our clients will be happy to know that in the 1 year since the recommendation, the stock is now up around 161%. Now, I've seen a few analysts suggest that Argan was a stock to buy in the wake of the Trump win, the theory being in terms of the construction and engineering sector generally, which Argan is a part of. Trump aiming to charter 10 new cities and underdeveloped federal land and streamline the approval of infrastructure projects. Essentially, his policies are good or should be good for energy infrastructure projects. I would say the more tangible reason for the jump over the past year was blowout earnings and a jump in backlog. We'll get to the backlog in a second. As you can see here, these are the headlines. They beat earnings considerably. The consensus estimate, and easily beat the most optimistic street estimates on revenues. This has driven the stock price much higher over the past year. The gains in a tough market are really just a continuation of this positive trend, positive outlook in quarterly conference calls from management, and backlog moving to record levels with significant new contract wins. Let's take a closer look at the just released Q4 numbers. We can see here revenues up 41%, earnings up 161%. Gross margin was up from 14.4% to 20.5%. Something here that we were monitoring as gross margin in the Q2 period dipped, but it's come up over the second half of this year. EBITDA was up. The dividend was increased, both significantly. Let's look at the year or the annual results here. Again, growth across the board. Let's take a quick look at a key driver moving forward. Strong contract wins in the quarter, pushed the backlog, grew to roughly 1.4 billion as at January 31st, 2025, included full notices to proceed on a 700 megawatt combined natural gas project in the US and a 300 megawatt biofuel power plant in Ireland. Following the close of the fourth quarter, the company executed on a signed contract for a 1.2 gigawatt ultra efficient natural gas fired power plant project in Texas. Management commented that as the company kicks off fiscal 2026, they are encouraged by the number of additional opportunities in the marketplace. Let's take a quick look at the balance sheet here. Management also stated that the addition of high energy demand data centers and the onshoring of manufacturing operations and the expansion of electric vehicles use are primary drivers for increasing forecasts of future electrical power demands and the robust pipeline of new business opportunities. Now, one of the elements that attracted us to Argan originally, which is a volatile business than we traditionally recommend, more volatile, given the contract-driven nature of its work, was the very strong balance sheet. Well, as we can see, as at January 31st, 2025, cash and cash equivalents were 525 million, up from 412 in the same period ended last year. Net liquidity is up to about 300 million from 245 million. No real share increase significantly there. And shareholders' equity is up as well. Let's look at the current valuations. These current consensus estimates for AGX fiscal year 2026 and fiscal year 2027. We note a slight expected decline in 2026 following by a significant uptick expected in 2027. This may be project ramp-up costs initially factoring in here. However, I would note that the consensus comes from only two analysts here, and the consensus estimates for the just fiscal year that we reviewed there, fiscal year 2025, by mid-2024 of the calendar year, those two analysts were estimating $4.27 for this past year, which they badly missed as earnings per share came in at $6.15. So I'm unsure if we can put a great deal of weight on these estimates. I would say directionally right now, with the strong backlog, we see a positive direction forward in terms of EPS. Conclusion here, just simply, we will be updating our clients over the next week. Again, the 160% gain in 1 year makes Argan our star of the week. Any comments there, gentlemen?
Oh, I was just going to say, I was potentially going to do a dog and a star this week, and it was tough to find a star. It was just over in the general markets, but Argan clearly shining.
Argan's certainly done well. I mean, and if we were in probably a more positive environment, the stock probably would have ran farther than that. You get in a negative environment, but to see the stock jump 25% in 1 day, you can see why. Tremendous growth in terms of earnings. It's funny, the stock is up 160% over the past year. I think earnings were up about 161%. It's crazy how we always say stocks follow their earnings over time. I mean, it did that over the past year, but I think maybe I might do a segment on that because I saw recent charting that showed the long-term compounded growth rate of free cash flow of some large companies, some mid-sized companies, and how they their returns almost match the long-term compounded annual growth rate, or compounded growth rate, of their free cash flow per share. So that'd
be interesting.
Yeah, it is. It's actually strikingly over the long term, not in the short term, but over the long term, striking how exact it tracks that over time. Anyways, all right. We can move on. I think we're going to have Brennan. Is Brennan looking at Lulu, or is it Brett? I think it was Brett, right? I don't know who's next. You tell me. What did I say at the start? Somebody.
You said Brett.
Wind that back. Okay, we're going to go with Brett then. Brett is going to look at a recent IPO. Coreweave.
You got that correct. Yeah,
that's true.
There we go. So, like Ryan was saying, looking at the IPO market with Coreweave, but before we really get into Coreweave, I just want to show how weak the IPO market has been the last few years, 4 years, going on 4 years now. So we had 2021, really the year of the SPAC is what I'd call it. We had tons and tons of SPACs going public. But since then, IPOs have just floundered both by the dollar value as well as the count of IPOs. And now we've been slowly seeing it gain a bit of traction, and Coreweave is really one of the headline IPOs, or expected IPOs, I should say, for 2025. So is it going to be a sign of things are turning around for the IPO market, or is it just going to be downtrodden markets from here on out? So moving to Coreweave symbol CRWV on the NASDAQ is an AI hyperscaler. The company uses proprietary software and cloud services to deliver complex AI infrastructure at scale. Simply put, really, they build AI-focused data centers. They have over 250,000 GPUs across 32 data centers with 1.3 gigawatts of contracted power. The company is an AI pure play, trying to capitalize really on that AI boom, which requires immense computing power and therefore immense electrical power as well. They currently have relationships with big names in the space with Microsoft, Meta, as well as recently OpenAI. So moving to the price, the IPO is really disappointing for investors in the company as well. That could be a bit of an indicator for the broader IPO market, just to show my cards a bit there. Initially, the company was targeting a price range of $47 to $55. However, the stock ended up listing at $40 a share and closed $40 a share the first day of trading. However, Monday morning, as we record this, the stock has fallen roughly 8% and is currently trading at $37 a share, resulting in market cap of $17.5 billion. That's about 28% lower than that midpoint range that the IPO was expecting last week. So not great for the owners of the company before it went public. Will say, however, this is quite normal for post IPOs to be quite volatile. And with the market being already so volatile as it is, especially in tech names, an 8% drop isn't the most surprising regardless of the company's underlying fundamentals at this time. And by the time you're watching this, I would not be surprised if the price was quite a bit different than what it is today. So moving to the financials for 2024, the company had revenue of $1.9 billion, significantly higher than the prior year's $229 million. That is clearly putting it in the growth spectrum of companies. They had a gross margin of $1.4 billion, a 74% gross margin. The main costs of revenues being electricity, rent, and just related later to operating their data centers. The big cost, however, for the company is technology and infrastructure of $961 million. This is electrical and computing components, depreciation expense, which are the main capital expenditures for the companies, mainly being GPUs. The company actually invested $8.7 billion, that's the cash value, roughly half the current market cap, into PPE, so property, plant, and equipment, and internal software last year. So a massive dollar amount put into GPUs primarily. And that results in a net loss of $863 million for the year on a GAAP basis. But looking at adjusted EBITDA, it does appear quite a bit better than net income at $1.2 billion, as you remove significant depreciation expense of $863 million, materially the same as the net loss, so you're at break even at that point, as well as fair value adjustments for derivatives, warrants, convertible notes of $756 million, as well as an interest expense of $361 million, being those big line items for EBITDA. Moving to the balance sheet, the pro forma net debt position, so adjusting for the funds raised with the IPO, came in at $5.2 billion. The company primarily used those IPO funds actually to pay down term loan debt of $1 billion, as well as providing a $500 million collateral for a delayed drawn down term loan facility. That is that jump in restricted cash of $500 million you're seeing on the screen. So effectively, the IPO capital was just used to lower the debt load, and with their interest rates being as high as they are, they had an effective interest rate of 14.1 and 10.5 for the first and second facility, respectively. Is not exactly surprising. They're looking to lower their debt load, as they are even further expecting to have significant capex going forward. Further, the company as well, I will highlight, they finance this equipment, which ranges from 9 to 11%. So overall, just not exactly cheap debt. It's not surprising they want to lower that load a bit. Using the pro forma net debt and adjusted EBITDA for 2024, the company had a net debt to EBITDA of 4.2 times. Quite high, especially given that the IPO actually reduced that debt load. So moving to valuations, using the 2024 figures and pro forma net debt, the company is trading at an EV/EBITDA of 18.6 times, which does imply a continuance of significant growth expected by the market, and I would as well, at least for the top line. As well, I will note here the weakness of actually using EBITDA for a company like this, as they are so capital intensive, and EBITDA removes depreciation. And further, the depreciation value used likely, in my opinion, does not represent the true change in asset value, which I'll get into in a minute why that's the case. And further, if you just look at the top line, the price to sales is 9.1 times, which is quite high as well, given the capital intensive nature of the business. Overall, even though it is trading well below the initially desired amount of the IPO, it is still a pricey business at the end of the day. So onto those couple of risks I want to highlight. The first risk, the company's GPU base is mostly Nvidia Hopper generation GPUs, mostly H100, H200s. So that is Nvidia's current leading API architecture. But of course, being technology the way it is, it does change, and it can change very fast, especially for leading edge technology products like AI and GPUs in general. Nvidia's next generation Blackwell is expected to be later released in the second half of this year, with initial Nvidia benchmarks result putting it at 2.2 times and 2 times Llama 2 and GPT-3 training compared to H100 GPUs. The point of this really is, me going through it, is that if Coreweave wants to keep up and being on that leading edge of AI infrastructure, they need to continue to invest capital, and lots of it. In this refresh, you'll likely have, in another few years, another new architecture that will likely have a refresh next year, and it kind of follows that cycle. New architecture, refresh, tick-tock. In that sense, they do change every once in a while, but that's a pretty normal cadence for any semiconductor. So the first Hopper GPU, those H100s, were released in March 2023. So 3 years ago, they had a refresh. About 2 years ago, that H200. The company depreciates its technology equipment over 6 years, meaning any Hopper GPU that they're purchasing now at this time today won't be fully depreciated until the architecture is 9 years old, which is a very long time for leading edge technology. And the performance and efficiency of its architecture by then will likely be poor in comparison to technology that comes. Remember, a big input for the company is electricity. The less efficient a GPU is in respect to the current generation, the less value it will have, even the resale value or new value, whatever you want to call it. So in my opinion, this likely understates the actual depreciation value to the true fair value of the underlying GPU, the capital, or the capital infrastructure, meaning capital expenditure also likely needs to be higher than the accounting depreciation financials would imply on the surface. The second risk I will highlight, on the other side of the equation, we really have supply of that AI infrastructure there, and now we're looking at AI training demand. That needs to continue to have high growth. The company references expected growth from Bloomberg of 38% from 2023 to 2028. Generally, AI growth I'm much less concerned with than the demand, the structure of the actual businesses here. But to keep that high valuation like Coreweave currently has, you need underlying growth. You need both top line growth to hit then the bottom line after that. But to get that top line growth in the first place, you need an industry demand that supports it. And if the whole industry stops running at this really breakneck speed now for the size it's at, especially when the company is largely funded by debt, that can run into problems. The AI boom is, of course, underpinning really the bull thesis for any of the bulls of the company. So AI, to meet that criteria, just needs to continue the rapid growth. Therefore, training needs to be done, and therefore infrastructure is needing, which is where Coreweave comes in. You need that whole chain of events to happen for Coreweave really to succeed, which starts with AI training being in demand. So concluding, Coreweave really has had a rough start with its IPO hitting the market under initial price expectations, and at least relatively early trading shows the stock moving even a bit lower. The business model is risky. It depends on the rapid growth of AI demand, but that can also be hindered by the significant capital expenditure which is needed to fund the company's core operations. And if the IPO is any indicator of having the capacity to even raise those funds, that could be a bit concerning, considering that it came in well under what it was expected to come at. Or perhaps it's just bad timing in a beaten down tech market for that side of it. But overall, I don't find Coreweave appealing at this time, since the debt load is significant. You have a high valuation. You're reliant on a depreciating asset, which is going to require that continuous capital expenditure. And for the price, even though they do have high growth, it just seems too high at this time for the risk and reward combination, We will continue to monitor the stock if it does come appealing, but for now we'll sit on the sidelines. And for disclosure, we have no position in this stock. And I will even say we don't have a short position, because people always say that when we're even remotely negative.
Yeah, good segment here. I think just generally too, like, it's interesting if, like, there was a lot of articles I remember reading just as Trump was taking office, and, like, I've got a Forbes article in front of me right now. Will Trump 2.0 reignite the sluggish IPO market? And, like, a lot of analysts in this article were saying, just generally deregulation was building enthusiasm, like, around crypto, energy, and AI. And they say in here, this is a quote: some sectors of the market will clearly benefit from what we believe will be reduced regulatory requirements, such as the crypto and AI subsectors for starters. If reduced regulatory scrutiny results in more rapid, if possibly temporary, growth in some sectors, the projected valuations will likely rise, and those improvements will translate into more enthusiastic or a busy IPO calendar. I mean, we'll see how this translates, but I think just generally the uncertainty that Trump has created has made more of a dark cloud above the IPO market in general. At least that's my take. Maybe you guys.
The market just simply doesn't like uncertainty.
Whatever causes the uncertainty. Uncertainty is something that leads to risk off and sell-offs, and you need, the markets want to make their perfect models, and you do that with a more certain environment, right? So if we don't have that, whatever is causing it, you don't have capital being deployed at the rates that you would see it in a certain environment, or at least a somewhat stable environment. So until you see some stability, the IPO market probably freezes up, and that's what you're seeing right now, I would say.
Yeah, I think that it's good too that like, it's another great segue, but Brett was just talking about growth, and if you see growth tapering, it can lead to compressed valuation multiples. I think that is a great segue into my Lululemon segment
that
here.
You're wearing right now.
And yes. And yes, I'm actually wearing dress slacks right now.
Dress slacks.
Yes.
Brennan, can you do a twirl? Can you
No, I do have Lululemon joggers on as we speak. So we'll say I remain a customer of Lululemon. But they are the dog of the week. And this is Lululemon Athletica Inc., LULU on the NASDAQ. Currently trading at a price of around $285, about a $40 billion market cap. And they design, distribute, and retail technical athletic apparel, footwear, and accessories for women and men under the Lululemon brand in the United States, Canada, Mexico, China, Hong Kong, and internationally. And as of February 2nd, 2025, the company had 767 company-operated stores, and approximately 75% of revenue was from the US, Canada, and Mexico, which they define as the Americas, of course. And 13% was from mainland China, and 12% from the rest of the world. So the stock is our dog of the week, as it is down 17% in the last two trading sessions, and has really had a difficult few years, as in 2024, the company indicated it faced a series of challenges which were impacting growth, including product-related headwinds, weaker US sales, increased competition, and general macro headwinds. So let's dig a little bit deeper into the recent results and the recent drop in the share price. Now, looking at the recent financial results for the Q4 and fiscal year 2024 results, ended February 2nd of 2025. Keep in mind, all of these results are in US dollars. Revenue increased 11% on a constant currency basis to $10.6 billion for the fiscal year, with revenue from the Americas increasing 4%, while international revenue increased 36%. Now, comparable sales increased 4% overall, with a decrease of 1% in the Americas, while international sales increased 24% on a constant currency basis. So there is still strength internationally that they're seeing. And growth in EPS, or earnings per share, for the year remained robust, with an increase of about 20%. Now, to put this growth in relation to its longer-term trend, revenue has grown with a compound annual growth rate of 22% over the past 5 years, while earnings per share has grown at a rate of about 24% over the same period. So we have certainly seen growth slowing in 2024. The balance sheet remains healthy with cash of 1.98 billion with no debt, but leases of 1.58 billion, providing a net cash position of approximately 400 million or $3.29 per share. So overall, the balance sheet remains healthy. Now, the primary reason for the recent drop in the share price was the company's fiscal year 2025 guidance, as the company is looking to grow revenue in the year to approximately 11.2 billion at the midpoint, which represents growth of 7 to 8% if we exclude the 53rd week of 2024, while diluted earnings per share is expected to grow to $15.05 per share, which at the midpoint is expected to be growth of about 3%. And in relation to the slowed growth in earnings per share, this does not include the impact of any share repurchases that the company may conduct over the course of the fiscal year. They have been buying back shares quite consistently, but the guidance does include the expectation for gross margins to decrease by approximately 60 basis points versus 2024, driven by deleverage on fixed costs, FX headwinds, and the impact of increased tariffs related to China and Mexico. And again, as I noted previously, revenue has grown with a compound annual growth rate of 22% over the past 5 years, while EPS has grown at a rate of 24% over the same period. So seeing this slowdown, the stock has certainly sold off further. And given these growth concerns, we are seeing the price to earnings multiple of the business compress, with a median price to earnings multiple of 41% or 41 times over the past decade, while it's currently trading approximately 20 times trailing earnings and about 19 times forward earnings. This is something that, again, we've highlighted many times when paying for an elevated valuation multiple for a business, as if growth slows, we can see a stock price fall due to a compression in the valuation multiple. And overall, tariff and potential inflation concerns have led to a decline in consumer confidence back toward 2022 lows, suggesting worries about the economy and labor market are impacting consumers' pocketbook. As such, the slowing growth and ongoing uncertainty have made Lululemon our dog of the week. But I should generally add that Lulu is a company which I would love to own given its strong fundamentals, its cash-rich balance sheet. But I believe the stock price may continue to have some pressure on it. And I would really like to see some indication of growth returning before I would invest. One of my friends was looking at the stock when it was around, I think the $340 range, and it had a little pop, and he was like, I told you so. It was the best time to buy. And while, he was up briefly, growth concerns going over the year could lead the stock lower. So it's really, again, that uncertainty. Will we see that growth pick back up to, the mid-teens or high teen range, which it had been growing at in the past? And if it can, you would expect probably that valuation multiple to expand. But for the time being, I think that the stock price may have some difficulty to find some ground or a footing.
Yeah, really strong company. One we're monitoring closely in our U.S. large cap service. Hard to maybe time the exact entry point, but if we get a significant discount, it may be a name that we look closely at. But yeah, and I mean, long track record of growth. We'd love to see an indication of growth going forward, but it's often hard to get everything in all the boxes you want to check off. But it is a good company that we monitor closely.
Yeah, and I did Canada Goose last week. I mean, again, I'm not saying to buy Lulu right now, but like if we were just to compare Canada Goose to Lululemon, just where things are right now, I would by far prefer to invest in Lululemon. And a lot of the times, that's what we're needing to do, is comparing businesses in the sector and whatnot.
Yeah, it's funny. We like the comparison like 5 years ago to that and Aritzia. there was one point where Lululemon was outperforming, but 5 years later, you're looking at Aritzia's gains far surpassing what went on, even with Lululemon, which is a tremendous company in the space. But Aritzia's gains are 250% in that range, and Lulu has not doubled over that period yet. So, a great company, and certainly outperformed Canada Goose as well. So, yeah. All right. Well, I think that is going to end our segment for this week. Aaron will be back next week. We apologize for that in advance. And we'll just remind you, we got seminars coming up April 3rd, April 8th. We've got 5 to 7 stocks, intriguing stocks that we are looking at today as good buys in the market. And as always, if you're watching this right now, smash that subscribe button on YouTube. If you are viewing this or listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.